This video is going to summarize a 2015 Farmland returns projections that are further summarized in a May 12th Farm Doc Daily article. These projections will be for Central Illinois farms with high productivity farmland, and they are going to be given on a per acre basis. In coming up with these projections, we will start by giving gross revenue or projecting gross revenue for corn, soybeans, and then a blend acre, which is 55% corn, 45% soybeans. Next, we will project per acre non-land cost, and these will include all cost for per farm production except for land. And then we'll arrive at operator and land return, which equals gross revenue minus non-land cost, and this is the amount that can be split between the farmer and the landowner. From this, we will show farmer return in two situations. One is a cash rent situation, and we'll look at a average cash rent, and also share rent, and we'll look at a 50-50 share rent with a $25 supplemental rent. Here then are our projections of gross revenue. The blue line gives it for corn, the red dashed line for soybeans, and the black double line is for a blend, which is again is 55% corn, 45% soybeans. There are actual returns from 2000 through 2014, so those are historical returns, and they are put there to put 2015 in perspective. These actual returns from 2000 through 2014 come from farms enrolled in the Illinois Farm Business Farm Management, FBFM. Note the relative lower returns prior to 2006. This was in a period when corn prices averaged $2.40 and was before ethanol was a major factor in our corn market. Post 2006, gross revenues for corn, soybeans, and the blend acre increased. We then had particularly high gross revenue, or the highest gross revenue during this period in 2010, 2011, and 2012. And during this period, both corn and soybeans were well above the averages and above the prices in the remaining period. Those prior year's gross revenues provide us perspective for 2015 gross revenues, and we come up with a projection for both corn and soybeans. Gross revenue is then composed of three items: crop revenue, 196 bushel yield times a 375 projected price. That projected price is a bit optimistic compared to fall delivery prices currently available in the market. $60 of ARC payments and $20 of crop insurance. The crop insurance payments result because that 375 implies a lower harvest price, and some farmers will likely get in crop insurance payments because of lower yields. Others won't. These are average projections. So that results in our $815 gross revenue projection for 2015 for corn. Similar to corn, soybean revenue is composed of three items: crop revenue, which equals 975 price times the 57 bushel yield, $20 of ARC payments, and $6 of crop insurance to give us $590 of crop or gross revenue for soybeans. Those two, corn and soybeans revenue, are then weighted average by 55% of our acres in corn, 45% of our acres in soybeans to come up with a blend revenue. And the blended revenue equals $713 per acre. This $713 per acre is below gross revenue in 2014. The primary reason it is lower is because we had exceptionally good yields in 2014, and the current projections are not for those good yields. We're using a trend yield for 2015 projections. The corn revenue again is projected at $815, and that, like the soybean revenue, is not known with certainty. Prices and yields are not known at this point, and various values of that can result in different gross revenues. We looked at different gross revenues that were possible, and those were published in an earlier Farm Doc Daily article. This graph from a April 28, 2015 Farm Doc Daily article looked at price and yield changes from spring to fall, and then that was used to project 2015 corn revenue, and the results that you see are shown here. Each one of the dots on the red line gives gross revenue. Each dot on the blue line gives crop revenue, The difference between those two are ARC payments and revenue insurance payments. The low revenue based on this historical analysis was $672 per acre, and that included ARC and crop insurance payments, while the high was $962 per acre. While there was considerable range, most of the revenues based on this historical analysis fell between the low 800s to the mid $800 range, and you see the circle there. It is possible that we will have lower revenues. It is possible that we will have higher revenues, but a good expectation at this point is corn revenues in the low to mid $800 range. Note further that the high, $962 an acre, is well below what the gross revenues were in the 2010 to 2013 period. This suggests that something out of the ordinary, at least from a historical perspective, would have to happen before we saw gross revenues above $1,000 per acre this year. Next, we'll turn to non-land cost, and this is figure 2 from the Farm Doc Daily article, and it shows non-land cost. Non-land cost increased between 2006 through 2013. In 2006, non-land costs were $302 per acre. They increased or doubled up to $615 an acre in 2013. That period was also the period when we saw higher commodity prices. Non-land cost, again, $615 in 2013. Non-land costs came down in 2014 for corn, primarily because of lower fertilizer prices. We saw that non-land costs go from $615 an acre to $590 per acre. We are projecting no change in non-land costs going into 2015. Fertilizer, seed, chemical prices have not or do not appear to have come down. Hence, we will have non-land costs roughly in the same vicinity as we did in 2014. For corn, that will put non-land cost in the high $500 per acre range. Subtracting gross revenue from non-land costs then gives us operator and land return, which you now see in front of you. As you can see, there's considerable range in operator and land returns over time. From 2010 to 2013, the blend, 55% corn, 45% soybeans, operator and land return averaged 483. That 483 again was 2010 through 2013. Operator and land returns then declined to $249 per acre in 2014. We are projecting a further decline into 2015. There we're expecting $226 of operator and land returns in 2015. Obviously, this operator and land return is what is left to be split between the farmer and the landowner. $226 per acre is a lot less to split than $483 per acre. The blend, operator, and land return are given in this figure, along with cash rents by the red line and share rents by the blue dashed line. The red line gives average cash rents. There is considerable variability in cash rents. These are averages. As can be seen, cash rents increased from 2006 through 2014. In 2014, the average cash rent for Central Illinois high productivity land was $294 per acre. Prior to 2014, cash rents were below operator and land returns, meaning that there was positive returns to farmers after paying cash rent from the operator and land returns. In 2014 and 2015, though, average cash rents exceed operator and land return, meaning that in an average situation, farmers generate losses on cash rents. In 2015, we're projecting a $67 loss on an average cash rent. The blue line gives share rents, which is a 50-50 share rent, and it also includes a $25 supplemental rent, which is paid by the farmer to the landowner. In 2010, 11, and 12, share rents, or average returns to share rents, were above those for cash rents, and as prices went up, the share rents also increased, and those share rents were above cash rents, meaning that share rental arrangements adjust faster to the higher prices than did average cash rents. In 2013, 14, and 15, share rents decreased because of lower commodity prices, and the share rental arrangement builds that sharing into the arrangement. And again, these share rental arrangements returns went down faster than the average cash rents. It's likely that if we continue to see lower projected prices in 2016, cash rents will come down as well in 2016, and that simply has to happen over time if we see average cash rents above operator and land returns. To summarize, both operator and land return and farmer returns are projected lower in 2015, and in 2015 the average cash rents are above operator and land return, meaning that farmers are projected to face losses on cash rent land in 2015. Cost and cash rents are largely set for 2015. There could be some changes if we see some unusual pest pressures and or higher or lower grain moisture levels, but overall we're set for 2015. Generally speaking, you would be hard pressed to see gross revenues above $1,000 given historical price and yield changes, and most likely in the mid $800 range. If we continue to see prices at their current levels, and by that I mean commodity prices in the low 3 to high 4 for corn, we're going to again face difficult decisions in 2016, and in particular those decisions will revolve around fertilizer, seed, chemicals, and cash rents, and farmers will be under pressure to reduce cash flows in all of those areas.